Welcome to Fear and Greed, the week ahead. I'm Sean Aylmer, and as always, I'm joined by economist Stephen Koukoulas. You'll find him at thekouk.com, thekouk.com, and on Twitter using the handle thekouk. Stephen, good morning.
Good morning. I'm still standing, but only just after last week.
Wow, what a difference a week makes. That just is, I'm not quite sure how. I mean, this time last week, we had just the Silicon Valley Bank stuff was unraveling. And then we got after we spoke, there was a rescue package and then Credit Suisse. Just, can you take us through it?
Yes, I think there was a bit of an assessment of how banks are funding and managing their balance sheet. So in a sense, I don't think there's a systemic problem from the Silicon Valley Bank to other banks. However, it's actually, funnily, a legacy of some of the reforms that were put in place after the global financial crisis, 12 to 15 years ago, that banks had to hold a higher proportion of their deposits in government bonds. They thought that would be liquid, safe, and all the rest of it. But of course, there was never this discussion of mark to market. So when they bought these bonds, all banks this is, and if they didn't hedge it correctly, which of course the Silicon Valley Bank's problem, when yields rose, which of course they have been for the last year, both official rates and bond yields, when they had to sell those to fund depositors withdrawing their money, they were selling them at a big loss. And if they had too much of a withdrawal of cash from their banking system, they were selling and making very big losses. And I think that's sort of why banks across the globe, frankly, were sold off, some more than others.
Okay, the Credit Suisse situation is a bit different, though. It's not about deposit base. That's more about the fact that one of its biggest shareholders doesn't want to put any more money into it.
They've burnt so much money on that one, yes. And I think when I was checking, I saw a headline that Credit Suisse is down 98% from its peak level in terms of its share price. So it's a basket case. Look, I must confess, I don't look at the entrails of how it's fallen so dramatically, and rescue packages abound, obviously. But it's clearly a combination of mismanagement, of poor judgment, and it's just it's spreading a bit of contagion through Europe, where other banks have exposure to Credit Suisse. It's one of those ones. But again, I don't think it's as bad as 2007, 8, 9, but it won't take much to tilt us a little bit more in that direction.
Almost makes things like the labour force figures for February and business confidence and consumer sentiment almost dull, but not quite.
Well, from a market's perspective, they went through to the keeper largely, even though there was important information in there. When we sort of take a step and what's happening in the economy, taking the labour market first, there was a lovely rebound in employment, plus 66,000 jobs in February. Now, that has to be put in the context that the prior 2 months were both negative. So everyone was expecting some sort of rebound, but it was lovely to see it. And it was actually a touch more than the market consensus. And it fed through to the unemployment rate going back from 3.7% down to 3.5%. So basically the unemployment rate, which had been looking to creep up late last year and early this year, crept back down again. But when we sort of put a trend line through the whole lot, that monthly volatility, you can sort of see that employment growth is moderating. It's still okay, but moderating from where we were, say, 6 to 9 months ago. And the unemployment's just stabilising around this 48, 49-year low of 3.5%.
How worried should we be about consumer sentiment?
Consumers are gloomy. Gosh, we saw, Bill Evans at Westpac putting out his consumer sentiment number, and it was remaining below 80 index points. Now, 100 index points is where you've got as many optimists as pessimists in the consumer side of the economy. So clearly we've got a lot of pessimists, and it's actually at a level, this is the thing that I found extraordinary, Sean, that it's at a level that's lower than the lockdowns when we were in COVID. So we're feeling gloomier now than when we were stuck at home, not able to go out. And it says to me that it's cost of living pressures, it's interest rate hikes, it's concerns about the broader economic outlook that's feeding into people's sentiment. And how worried should we be? When consumers are gloomy, they tend to hunker down. They tend to sort of be a little cautious or very cautious in their spending patterns. And, I think as we discussed a week or two back with the recent retail sales numbers, there's clear evidence that retail spending is slowing down.
Okay, but business sentiment is falling somewhat. The conditions are still pretty strong.
That's the good news, thankfully. And this is one reason why I don't think we're going to have a recession. To the extent that we were ever going to have one, the business sector's actually got a lot of internal momentum, if you like, that a lot of the projects that they had ready to rock and roll during the COVID lockdown were actually postponed. They postponed their decision for IT investment for buildings and structures and these sorts of things because they just weren't sure what was going on, or they couldn't even find the machinery and equipment. There were supply chain problems. So now we have this situation where businesses, when they're asked, what's your outlook for CapEx, for example, it's pretty upbeat, and their measure of conditions is pretty good. So not booming, but certainly way more optimistic than we consumers. And when you sort of extrapolate those numbers from the NAB survey, it points to business investment growing this year and next by a pretty decent amount. And to get negative GDP, you really need something else to go horribly wrong, and that just doesn't look likely.
Okay, now this week, there's not a lot on this week. We get the Reserve Bank minutes, which of course is always interesting, but the interest rate setting policy committee in the US also meets. So we'll find out whether US rates are going to rise again.
Oh, and yes, with all the choppiness of last week with bank failures and news and all the rest of it, the market pricing for the US interest rate setting this week is all over the place. We got to a point where I think just before the bank failures, they were pricing in a high probability of a 50-point hike. When markets were absolutely in turmoil, they were pricing in zero chance of a hike. And I think there's a small probability of a rate hike as we speak priced into the market. But it is so fickle. And one thing that I think we've learned over many, many years, many decades, in fact, is when you have a financial or a banking problem, the last thing you want is more interest rate hikes. And, and as we've been discussing and everyone's discussing, there's a lot of rate hikes in the pipeline that haven't impacted just yet. So to me, it seems as if it would be prudent for the Fed to pause. They can always resume their hiking cycle if the dust settles and things are okay, but pause for this month, because if they hike rates and the market has a bit of a turn, it could be very, very nasty.
It's going to be very fascinating to watch, Stephen. Have a great week.
Thank you, Sean.
That was economist Stephen Koukoulas, better known as The Kook. You can find him at thekook.com and follow him on Twitter using the handle The Kook. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.